Hi guys, welcome back to SHKExcelWorld. I'm Salim Heather and we have been going on with our series on financial modeling with SHKExcelWorld. And as promised, today we are going to create and calculate one of the most important parts of financial model, which is the fixed assets. So this has two elements, one is the cost and second one is the depreciation. So the problem the financial modelers face most of the times is the automation of both of these elements. Like the fixed assets are replaced at the end of their useful life. So the cost will have to be automatically added at the end of the useful life of the asset. And for the depreciation, on a straight line basis, how we can automate the calculation of depreciation with a single formula. So without wasting time, let us go to the computer screen and see how we can automate both of these elements. But first, don't forget to subscribe to SHKExcelWorld and also share this series with all of your friends who want to learn financial modeling. So guys, this is a file we are using today. You can download this file from the link given below in the description, and this has a complete template for today's working. And for your ease, I have also given the link to the complete file, the complete version which has all the workings intact and linked to the financial statements. So as discussed in the introduction, we have two elements to work with. One is the cost and second one is the depreciation. And for the cost, we first need to know the assumptions. Let us go to the assumption. We have a very simple set of assumptions which says that what is the year of purchase for each type of asset? What is the life of the asset? So if the life is 6 years, we have to repurchase the asset in 7th year, and for this one in the 6th year, and so on. And what is the cost of the asset in the first year of purchase or the first purchase? So this is a simple set of assumption, and let us go to the working now. So for the cost, we need to know the inflated cost of each type of asset in the respective years, so that when we want to purchase the asset, we should know the inflated cost in that year. And then we will automate the replacement based on the useful life of the asset. So if the life is 4 years, 5th year cost will be added here as an addition. And then for the depreciation, again we have to automate the depreciation. And this is just the accumulation of depreciation of previous years up to the specific year. And then we will deduct the accumulated depreciation from the cost to know our book value of the asset. So let us start, and for this particular purpose we are just going to assume a straight 8% inflation rate. Otherwise you can see that the assumptions have a variable inflation rate which changes every 5th year. So here you can use the index match function, and we are not going to spend too much time on that, and we are just going to assume the 8% inflation rate here and copy it to all of the years. So now it's very easy. So this cost of the asset is cost at time 0 or at the start of the first year. So we can write it here. And just copy the cell references. And since we are assuming the cost at the start of the year, so it will be the same. And for the second year, which is end of the first year or start of the second year, we are going to multiply this one into 1 plus the inflation rate in the previous year, and bracket close, and just we have to freeze the row for inflation. Just press F4 twice and your 21st row will be locked. Now we can easily copy it to rest of the cells. So this is very simple. So now comes the interesting part. We can see in the assumptions that the plant and machinery has a life of 6 years. So which means that we will purchase plant and machinery in first year, and in the 7th year, when our plant and machinery is fully depreciated, at the start of the 7th year we will add this cost, which is 1.5 million. So target here is to create a formula so that this 1 million is picked up in the first year and this 1.5 million is picked up in the 7th year, like this. So here we are going to use the MOD formula in combination with the if formula. So MOD formula will be in the logical part of if formula, and the logic will be if we divide the year with the life of the asset and if the remainder is 0, then it will pick up the cost, otherwise it will not. So equal to if, and logic will be MOD and your year number, press F4 twice, comma, and go to the life of the asset. So this is in D column, so we have to lock the D column, and the row number will be free. So if MOD, year number and life of the asset, if the remainder is 0, then it should pick up the cost. So we have discussed in our previous video that if your formula gives reference to the same sheet by including its name, so it is somehow confusing for the reader. So we will just delete the sheet name and the formula will be left. So give us the cost, otherwise we do not want to pick up the cost, and press enter. So there is an issue. If we copy this formula to the rest of the cells, so it has picked up the cost in the 6th year. Because the useful life of the asset was 6 years and 6 divided by 6, the remainder is 0. So it has picked up. But we know that the asset will work up till the end of 6th year. So it should be the 7th year in which we want the replacement cost to be added. So what we can do here is that we can deduct 1 from our year number. So 1 will effectively be 0. So 0 divided by 6 will be 0. And if we copy it to all the cells, so what this cell is saying that 7 minus 1, which is 6. So 6 divided by 6, the remainder will be 0. And then it will pick up the cost because the logic is true in this case. So now we have automated our addition. We can easily copy it to the rest of the items. Here we go. So you can see that this is so amazingly done. This asset, which is furniture, let us go to assumption. It has a useful life of 5 years, and it is now being replaced in the 6th year with the inflated cost. And for this asset, it has a useful life of 3 years. So first year, it is purchased at the start of the first year, 2nd year, 3rd year, and at the start of the 4th year, the asset has been purchased with inflated cost. If we change the useful life here, we can say that it is, let's say it's 8 years, and go on to the working. You can see that it is now being added in the 9th year. So our first thing is done. Now we can easily refer the additions from this working and just ignore the disposal, because what we have assumed is that there is nil value of the asset at the end of its useful life. So there is no case of disposal or scrap value earning. So just leave it, because we are focusing on the simplest form of fixed asset automation. And this will be your opening balance, and you can copy this one here, and this is very simple. Now you can just copy it to the rest of the cells, and you have a growing cost. So 1.7 is the first purchase in the first year, then you have an addition of 629,000, in the fourth year, which makes the total cost to 2.3 million, and then there is another addition in the seventh year of 2.3 million, which makes the total cost to 4.7 million. So this is the cost of the asset. Now, if we want to calculate the book value, we will have to calculate the depreciation. Guys, let us take a break because it is too much to consume in a single video. So, in the next video, we are going to automate the depreciation calculation with a single formula. So stay tuned and see you in the next video. Till then, bye bye.